While food and drug retailers delivered an 8% increase in year-to-date performance, furniture stores reported an 18% increase in the same period. Joining us in studio to shed some light on these two sectors, Syd Vianello, retail analyst at Nedgroup Securities. Well, Syd, where do we start with this retail story?
Well, when I was phoned today, I said we'd talk about the food and drugs specifically, so I thought of a few points. I think pointer number one is, I've been saying for a long time, and we're talking of maybe 2-3 years, that there's been a major shift from the informal sector to the formal sector, and obviously that was in food retailing, and that was ultimately going to affect the people who supply the informal sector, and that's the wholesalers, because at the end of the day, something's got to give. You know, there's no ways that a company like ShopRite, for instance, has grown at the rate it has because the market's grown at that rate. The market hasn't grown at the rate they've grown, nor Spar for that matter. The market's grown mainly because they've taken market share from some of the formal sector competitors, but they've also taken from the informal sector. And we calculated very simplistically that the share of market held by the informal sector or the formal sector had increased from about 60-odd% a number of years ago to close to 68% at the moment. It's probably gone slightly higher since. I think it's going to peak at about 75%. But nonetheless, something has to give. And I think you've seen the first casualty, major casualty in the wholesale sector. The company like Metcash Africa is effectively closed down and or closing down, and its branches have been bought by many of the retailers.
Are you expecting more casualties?
I don't think so, because they were the weakest of the lot. They were subject to a private equity transaction, obviously burdened with a lot of debt, and they struggled to get out of that. But the bottom line is that that's probably the major theme in the industry, which is now going to be digested. The other one, a lot of people were questioning yesterday, why did Click's price jump as much as it did? I mean, has something fundamentally happened at the company that's caused the share price to jump as much as it did? Well, I never believed so. And I see, just before I came here tonight, I see it's been formally announced that Walgreens Incorporated of America has bought 45%, and within 3 years will take out the other 55% of the Alliance Boots business in Europe, which is Europe's biggest wholesaler, drug wholesaler, and Britain, of course, through the Boots part of it, Britain's biggest drug retailer. And there's always been a lot of speculation, because David Neal originally worked for Boots and what have you. And there was always been a lot of speculation. I guess the share price had something to do with it, that perhaps Alliance Boots would take control of Clicks and make an offer to take it out one day. Well, I didn't believe it would ever happen. It may happen one day, but I don't think it's going to happen in the short term, because Alliance Boots is saddled with huge amounts of debt. It's still £7 billion. And even after the transaction with Walgreens, the £7 billion is still there. Obviously, it's going to come down over time. But, you know, with now Walgreens, who will ultimately dictate what's going to happen at Alliance Boots, as much as I think they say, or it's claimed, that they part of the rationale behind the acquisition is they want to get into the emerging markets. You know, you've got to digest the acquisition first before you start looking at making more acquisitions. So as much as it may happen in the future, I don't think it's going to happen tomorrow. That's really what I'm saying.
Now, Syd, what do you this move to the formal sector from the informal sector? Are we 3/4 of the way through that? How much more legs? How much more can we go? Because as you quite rightly said, you can't get 8% real retail growth in an economy that's only growing at 3%.
No, you're not going to get it. Well, I think the figure, well, we worked out about 6 months ago, the figure was about 68%. Internationally, and I heard this figure from the Walmart people, who've obviously done all the research as part of the takeout of Massmart, or taking of control, that internationally the figure normally settles at about 75%. But remember, the legs now have got a lot, they've got to run a lot harder to get from 68 to 75 than where they were 10 years ago at slightly over 50. You know, 50 to 68. The hard work the major market share has been captured.
Yeah. And why have people done this? Is it just that there's just bigger footprint? There are now 2,000 stores instead of 500 stores, or is it a price point
Well,
issue?
a lot of it has to do with price, because wholesaler pricing is not really any cheaper than retail pricing, which means that the small retailer will ultimately charge a lot more than what the formal retailers charge. The formal retailers have been reluctant to, or prevented from, whatever the case may be, from getting into the informal market, the townships and what have you. And remember, I mean, South Africa's demographics is very simple. I mean, of your 50 million people, 80%, 85% live in townships. That's where the major market is. And that's why you've seen this huge growth in store openings and what have you by the major retailers, particularly ShopRite, moving its footprint into the informal market. I mean, it was an untapped market. Their market share was 0. Now they take an increasing part of that market share. So I mean, it was like just waiting. It was just waiting to happen. Eventually, it did happen. They had the let's say the courage to go into the markets. There were always fears. Stores were going to be robbed. The distribution system, the trucks were going to be robbed and looted and what have you. I mean, there were all sorts of stories going around. But eventually, they overcame the fears, and it's all proved to be completely senseless. And now, of course, the store openings are predominantly in that market.
I want to come back to the food retailers, and specifically looking at a group like Spar. We were chatting about Spar recently on the desk, and they don't have a strong presence outside of South Africa. Do you think that that's a disadvantage when you've got the likes of a ShopRite and the likes of a Woolworths all moving onto the continent? Is Spar a disadvantage?
I don't think it's a disadvantage. You know, Pick n Pay doesn't have much of a presence outside of South Africa either. And the way they're going into Africa, some of it through corporate and a lot of it through franchise. Franchise into Africa, in my mind, isn't really going to bring much of a return either. Spar, remember, operates. I mean, the reason why they don't operate in Africa is because they're obviously given territories or allocated territories as Spar of the Netherlands, the cooperative head office, so to speak, or holding company, which governs the way the Spar brand operates worldwide. And the only places where they're allowed to operate, obviously they have a stake in Zimbabwe, and Zimbabwe in turn controls Zambia, and they have the rights. Spar South Africa has the rights to go to Mozambique. I think they will be able to, if they want it, they'll be able to get Angola. But they've told the presentations that to go into a country like Angola needs a distribution network. And remember, they don't operate retail stores, or they don't want to. So they have to find reputable, let's say serious operators in Angola to buy from their distribution center before they can set up.
So would you prefer to see them just sticking to their knitting in South Africa?
Stick to your knitting in South Africa. There's plenty of opportunity for your brand here. And of course they have the two sidekick brands which are growing at the fastest. They're growing the fastest of all their competitors in building materials and in liquor.
Tops. So it's Tops is the liquor one, and Build It.
And Build It is the other one. Both are the market leaders in terms of growth in their respective markets. So why on earth do you need to go into another territory? Stick to your knitting, because you're making very good solid margins. It's not going to shoot the lights out like what the market believes ShopRite will do down the line when Africa performs. But of course we don't know when Africa is going to perform.
But now, Syd, with 20 plus PEs on a lot of the retail shares, what do we do now? Do we just hang on to the coattails of the foreigners because they still love them?
Well,
or do we say they're expensive and we sell?
I'm not so sure that I'd be selling. I like Spar. Spar I'd buy. Pick n Pay, you're buying for recovery. Yes. The AGM was on Friday, and they've said again that perhaps the promised rewards are going to come a little bit later than what we anticipated. But I guess that's a fair comment. And the last thing that the new management team want to do is to create an expectation that they can't deliver. Rather take away the expectation and actually deliver earlier.
Under-promise, over-deliver.
Yeah, exactly. And I think that's what they're going to do, but I think they're on the right track. ShopRite, fundamentally in my mind, is overpriced, but it's all predicated on the African expansion. But the last thing you want to do, with everybody loving the stock, the last thing you want to do, I think, is to sell it. You want to be there just in case they deliver early.
You don't want to miss the boat. I mean,
I don't want to miss the boat.
Then the other question is, what happens if you're not in the retailers? What happens if you are not in the retailers at this point in time?
I'd go and buy something like SPAR. SPAR's earnings, the half-year earnings, were distorted by many, many factors. All of those factors were essentially one-off items. They're all going to reverse in the second half of the year. And you're going to see, in my mind, you're going to see very good earnings for the year to September. I mean, it's going to be absolutely nothing like what you saw in the half year to March.
What about Lewis?
Lewis, we actually calling Lewis as a buy. The furniture industry is struggling at the moment, but the biggest single driver of furniture company profits is the movement in the impairment charge, which is a combination of the actual bad debt write-off and the movement in the bad debt provisioning. And I've been through my models and what have you, and I still find that Lewis can deliver very sound earnings for next year, even if, as we forecast, the turnover growth is fairly mediocre, because you've got the ramping up effect, the long-term impact of extended credit and things like that coming as those things start embedding themselves in the income statement. Remember, when you convert from 24 to 36 months credit, you're selling more insurance and what have you, but that income is spread over a period of time. But over time it becomes embedded in the system, and that then starts coming through over time.